this class, okay? So quick takeaways. Let's have takeaways from those, all of you who were here on Wednesday's class. It was it was one class that well, I would say it was well received because you guys held me up for 30 minutes, virtually holding me hostage till 7:30. So you can ask questions from that class, from previous classes, take away from that class, any question from the work you currently do, just about anything you want us to discuss with this first 15 minutes I give out here. Michael, let's start with you.
It is even because of, you said we are running out of time. Only one person is left, and that is why I did not raise up my hand to ask my question. My question is this. The SLA. And we've had an SLA, you know your position, you know what the customer wants from you. But after signing the SLA, you still want more things that is not inside the SLA. In that situation, what do we do?
Negotiate. Anything else not in the SLA, will it cost you money? Does he need to pay for it? Can he provide it if he pays for it? Negotiation, everything is negotiation, communication, right? Instead of pushing back and saying, hey, check your SLA, not there, you simply come back and say, I would love to do it, but it will cost you ABC, right? Because it's going to cost me time and effort and materials and whatever it will take to do that extra. Or this thing you're asking is not within my scope, my remit, but I know, you know, how you can get it. Mr. ABC company, ADC can help you, right? So there are ways to get around those without having issues, but you must know what your SLA covers and be polite in explaining to your clients what it covers, so that if you want to do the extra, you want to be paid for it, you talk about it. You can't do it, refer him or her, please go ahead, okay?
That is the problem, sir. They just want the technicians to go ahead and do the job that is not in the SLA. And the fact that the company intimate the technicians about what they should do and not what they should not do. When the technicians tell them that this is not in our scope, then we refer to our boss, they get angry.
Okay, so it's because when you have such a situation, capture all of those things that they normally will ask your technicians to do, right? And create an SLA for them. For example, an estate, I don't know what circumstances are, but an estate can say, FM, manage just the common areas. But people want the electrician to come and change their bulbs, replace valves, stop leakage, repair electrical faults, and the rest. No wahala. What I'll do as the FM is I'll create a list of all of those types of repair and put prices to them. You can call our electricians from now on to do ABC, but these are the rates. Call out to do an inspection to check anything in your apartment will cost, you know, 10 naira. So and so repair will cost this. Then you create work orders. So when the electrician is being called, the electrician is going with a work order booklet. So fill in the request, put in the amount, sign, and the client sign, so that when the payment is coming to the company.
Thank you, sir. Good evening, friends. I learned that as long as the client is not requesting or asking us to bend the rule, to break the code, the standard, then what the client is asking for is her quality or his or her quality, and we should be adaptable to be able to satisfy the customer or the client. Super. As long as it's not breaking the rule, any of the standard, we should be slightly reasonable. You know.
Yeah.
I saw that. Okay, can you hear me now, sir?
Yes, your audio is good.
Okay, I was asking, sir, that while I was reviewing the assessment we were given, I was just checking out some other resources, and I came across something called the 5 dimensions of quality, something like that. I was trying to understand it in terms of the quality measurements that we had on the slide, and just trying to get them together. I wanted to ask her, if you don't mind, if you could just highlight on that. You talked about tangibility, reliability, assurance, and things like that. I was trying to understand it in the light of the quality measurement examples that were given to us.
Okay, every author will have their own way of packaging this lesson. That's why it will not be reasonable for me to try to interpret what another author has said. But what you can do is chat me on WhatsApp. I can just take a look at what he's writing. But because the moment you mentioned those words you spoke about now, you'll most likely be talking about quality in an industrial setting.
Okay.
And then there will be a difference between, I started the class by saying quality is not grade, right?
Yeah.
Grade has quality at every level, right? And we in the service industry have, very subtle ways of measuring quality because it's based on the perception of the user or the person who is paying for the service. Yes, so that why in industrial settings, in tangible products, they may have certain standards they have defined as quality at different levels that everybody will have to tie into. When it comes to service industry, quality is determined by the person you are serving.
All right, sir.
Yeah.
All right. Thank you, sir.
You're welcome. All right. So tell me how your week has been. Who's got a big challenge that he wants us to deal with? All smooth sailing? Yes, Kiki. Let's hear from you.
Yes, good evening, sir. Good evening, everyone.
Okay.
Actually, on Monday, I had an issue on my site, which I remember vividly. I called you. We wanted to install a submersible pump. So already I have a spare joining kit, 3M, that we normally use. So to my greatest surprise, after mixing everything, so we pour it on the container. So we are expecting that within the period of 10 minutes, it should solidified. But 30 minutes, the thing was still like watery. So I was concerned, and my concern was just because the issue of water is a critical thing. Even my office never want to hear anything like water crisis in the estate. So I was confused. I don't know what to do. That was why I called. So at the end of the day, you advised me that we should wait until the things solidified, which we did. So somebody now suggested, one of my technicians, that maybe next time, instead of using this thing, that we should be using silicone. So I want you to help me throw more light if it is advisable to use silicone in place of that 3M. Thank you very much, sir.
Okay, so silicone, what you have there is the same thing as silicone, right? Just that you have silicone brands made in the market and the ones that the electrical manufacturers package with the jointing kits for armored cables and jointing of cables that go underwater. So in essence, if you are having an issue of grade when you buy a certain kit and you're concerned, then of course you can improvise. It's not supposed to be a problem. The important thing is you want to keep the cable away from water. Whatever you need to do to keep the cable away from moisture will be valid. So that's not a bad approach, Kiki.
Thank you very much. I appreciate it.
You're welcome. Ndika.
Okay. Good evening, sir. And good evening, everybody.
Evening.
Yeah, so mine is on the head ground. I was admitted last week, actually.
Oh dear.
So it was very rough for me, and even though I struggled in between time to see if I can meet up with the lecture, even while I was in the hospital on drip.
Oh dear.
It was I called my wife actually called Madam Baraka,
Baraka,
to tell her about it. Yes, yes, to tell her about it. But
okay.
all the same, I'm better now and I'm back on my feet
Okay,
again.
thank God. Thank God.
So I know I missed a little of what happened last week. Even yesterday, I was also struggling because where I was admitted, it was very pretty bad. The network was pretty bad around that environment. So, but right
Okay.
now I'm better and I'm back
Thank God.
again.
Welcome.
Thank you,
Welcome
sir.
back.
So I missed out a little.
No
Thank
problem.
you.
You're welcome.
Thank you.
Abdul.
Hello.
Yes.
Good evening.
Good
My
evening.
question is on my last class. You talked about quality measuring tools. How can we use the popular one I know is the square meter measurement for charges. But here I saw cost per acre, number of employees per square feet, and the rest. So please, if you can throw more light to tell us how
Okay.
to go about that to use in charging people, clients and all that.
Really, it's not really about charging clients. It's about tracking improvements and performance. You know, if Mr. A spends ₦1 million in generating power, and Mr. B spends ₦2 million in generating power, nothing in those numbers tells us who did better. The difference between ₦1 million spent versus ₦2 million spent is irrelevant until you know how many kilowatt hours was produced with the 1 million and how many kilowatt hours was produced with the 2 million, right? The moment you know how many kilowatt hours was produced by each of them, you divide it out to get a metric that shows whether you are improving or you are not. So if Mr. A that spent $1 million actually achieved 49 naira per kilowatt hour, whereas the guy who spent 2 million achieved 46 naira per kilowatt hour, who did better? The one who spent 2 million naira, right? So if I were to be tracking your power generation efficiency, I would not be looking at the absolute measures of total amount spent. I will be focusing on cost per kilowatt hour, which means I will be using that to track whether you are doing better. So I want to compare how well you were doing with your energy efficiency 2021 versus 2020. The total amount is irrelevant, okay? The amount per unit, which is the metric, is what's going to tell me whether you did better in 2021 compared to 2020. Now, why are we doing this? Your cost drivers, your utility drivers, your performance drivers will be changing. It is a good thing for drivers to change, but the rate of change of input should be slower than the rate of increase of the driver. For example, I use 1 million liters of water. I serve 1,000 people. That is 1,000 people is my driver for water use. And as such, the metric is 1 million liters divided by 1,000. So I am doing 1,000 liters per person per year. That is my metric. Next year, how am I trying to show that I'm improving? The number of liters may drop. The number of liters may go up, right? But I want to serve more people. If I served 1,000 last year and I'm serving 2,000 this year, it means my company is making more progress, right? It means we're having more revenue. People, after all, because of people we have the business, right? But the increase from 1 million liters of water should not be equivalent to the rate of increase in the driver for water use. So tracking how many liters of water I use from year to year does not tell me whether I'm improving or doing better. Tracking the metric that divides my total input by my driver, efficiency driver, performance driver, or cost driver is what you use as quality measure. So in all of those cost per kilowatt hours per, and all of those things we gave you. We are telling you, always learn to generate metrics so that you can be reporting on metrics. Metrics are the things that when you trend them, it shows that you are doing well. Absolute numbers are meaningless when it comes to continuous improvement and quality, because they are being quoted in isolation of their driver. A school that has 1,000 students versus in 1 year, and then increase to 3,000 students the next year. And then the proprietor is shouting on the FM, how come your diesel cost is rising from 10 million per annum to 15 million per annum, and you are jittering and looking for how to report your improvement? You're not being sensible, right? But if you were always reporting your diesel cost as diesel cost per student of 11 naira, now we are 3,000 students. Diesel cost per student has dropped to 8 naira 50 kobo. Even if my diesel cost went from 1 million to 15 million, provided I'm tracking the right metric that shows improvement, I'm improving in quality. Okay?
Sir, but how do you track your diesel cost per student? It should be per use.
Yes, now. Total number of students, I know. Total liters of diesel I use, I know. I divide. Straightforward. I divide it every month, every semester. Did you get that?
Yes, I did. Yes.
Exactly. So
just like the total number of staff in an
exactly.
office.
I know people in the building. I know the liters I'm consuming, liters per person. I know number of people. I know kilowatt I'm producing, kilowatt per person. I know my square meters. I know kilowatt I'm producing, kilowatt per square meter. I know my cost of cleaning. I know my total square meter cost of cleaning per square meter. Do you get what I'm saying? Those are the things you track, metrics. They are called metrics. Focus on those, and your report will be top notch. And you will know what to trend, track, and improve on a regular basis. Don't separate your driver from your absolute. All right, so I'm going to go right into today's class. We're looking at financial management. I'm going to pop up the slide and take a quick break. Let me just share my screen. All right, I'm back. Is my audio good? Do you hear me okay?
Yes, sir.
Loud and clear.
That's awesome. And you see my screen, right?
Yes, sir.
Yes.
All right. Excellent. Excellent.
Yes, sir. Your audio is clear here.
Super. Thank you so much. So we want to look at certain financial concepts when it comes to facility management. It's not a finance class. It's a class to teach us how to think about money, how to process money, how to analyze and put justifications for spending of money, and how to show value for the monies that we spend. That's basically what we're trying to do in the financial class. Once you know how to elevate your thinking about money to that level of the CFO or the CEO, you will get more approvals for most of the projects you embark upon. You will get less refusal to execute proposals that you put forward. You will get more harmony between you and those powers that control money in the organization. Because everything I'm going to be teaching today about financial management is already known by the guys in finance, by the CFO, and by the CEO. This is how they already think. And this is what places us at loggerheads with them when we make certain proposals and propositions that we may think in our native intelligence makes sense, but it doesn't make financial sense at all. And they may not be in a position to educate us, right? So they penned it, they KIV it, they reject it, they not approve it, they query it, and so on and so forth. And then you go back, complaining or sulking. So we're going to look at guidelines for FM operations of financial activities, how we relate with other departments, basically how money moves around. and our roles in that relationship, in those relationships. Life cycle, how to think long term, end to end about money. FM costs, budgeting, some of the modules we'll be covering. Let's start with this guidelines. For me, this is more like a set of principles to live by. If you're working in an organization and you are working in a department that is a major spender, okay? You're not only working in a department that is a major spender. In fact, outside salaries, which is HRO costs, the next biggest overhead category in virtually all organizations is real estate, property, FM. So you are a major spender. You are also not just a major spender, you are a multifaceted spender. The one that spends more than you probably spends on medical, salaries, benefits, insurance. You can count them in one finger, in one hand, all the things that HRO spends money on, training and the rest, right? But you in facility management, you spend money in tens of contracts, different activities. You spend money lump sum and in bits almost daily. You are like a spender, a spending machine, and you often become a source of concern to the organization if you don't know how to think differently about the monies that gets to be spent through you. So that's what we're looking at, this set of principles and guidelines. Number one, understand your organization's mission and how the FM budget and financial decisions move the organization towards that mission. Let me move you, rewind back, recall our lesson on strategic facility planning when we put up the big picture that showed the 7 levels, 3 levels of strategy and 4 levels of tactical and 3 levels of operational activities in the FM organization or in a typical organization. At the corporate strategy, we say the organization has a vision, a mission, and strategic objectives. How does these 3 things relate? These 3 items relate. The vision is the end goal, what the organization hopes to achieve, hopes to become, hopes to be perceived as. If all goes well, we will be our vision. Now, with such lofty vision, you need to be acting in certain ways, behaving in certain ways, doing certain things that moves you from where you are towards that destination of your vision. That is your mission. Your mission is the set of activities, behaviors, the principles to live by that leads you to your vision. So if I were to put it in another way, I would say the vision is the picture and the mission is the practical path to that vision. The picture of my destination is my vision, and my mission is the path to my vision. What then are my strategic objectives? My strategic objectives are a breakdown of my mission into milestones. If I am on this path, I must be achieving certain things at certain times to let me know, to show, to demonstrate that I am on the path to my vision. So I am acting out my strategic objectives on the path of my mission towards my vision. This is at corporate strategy, and you are the FM. I hope that after that class, you started thinking of yourself as a strategic manager, not just an operational or tactical person who just gets and spends and moves on. No. And that's why I'm reconnecting this there, because the moment you can get up to the level of strategic thinking with regards to money, you are truly strategic. So the mission of the organization should guide financial decisions. Every financial decision. It will affect whether I stock or I buy as I go. It will affect whether I pay deposits or pay 60 days later. It will affect whether I decide to buy, do things in-house or to outsource. It will affect, virtually every decision that I make. And I will have a sense of connection between every decision I make and its impact on a strategic objective. Why do I want to buy a chair, an ergonomic chair for a staff to use to work? It's not just because the staff made a request for chair or because company standard is that we should provide chairs for everybody. No, it's because there's a strategic objective in our mission that says we must be productive. We must enhance or improve staff productivity. Providing an ergonomic chair for a staff is no longer for the fun of it. It's now tied to the productivity strategic objective in our mission as an organization. So if I'm asking for money for chairs or to paint the environment to improve the ambience, I want to think of what part of my organizational strategic objective and mission I can anchor that expenditure on. That is the only way I can show value. That is what that first point is. Number two, establish rapport with organizational finance personnel and external customers. The way we prioritize how important it is for us to have the resources we need to deliver on the solutions that will help the company excel and grow, we seem to overrate our relevance in many instances without even being able to define that relevance with proper anchors to strategy. So while we are struggling on our path towards strategic positioning, we need to be good neighbors and good friends. We shouldn't be holding the organization to ransom. They are doing a lot of prioritization in departments that controls money. The way you prioritize money that comes into your organization is first take care of FM needs. But the finance guys, the procurement guys, the CFOs and the CEOs and the other directors of the rest you have in the organization, they're not thinking that way. They have other priorities. So you do two things. Do number one, which means demonstrate value, demonstrate connection between what you are looking for that resources for and the corporate strategy. And two, make sure there's a good relationship so that people are not prioritizing only because you are technically sound and you can make sense with your business cases, but also because they like you as a person. Clearly define roles in the FM budgeting process. We'll talk about budgeting again today, but everybody must know where they play a role in budgeting. Is my company a top-down budgeting organization or a bottom-up? We'll talk about them in a bit. But you must know your role in budgeting, and you must know how to capture budgets accurately. Many of us have a budget for things that happens routinely, and we don't have a budget for things that come to hit us surprisingly, or the so-called unexpected. If you don't have a budget, you shouldn't expect money for it at all. But we seem to want to make a justification that we didn't see it coming. And as such, management should bend over backwards, go and find the money to give to us outside budgetary planning. That's because you failed to do a proper budget. Your budget should include a risk management plan that identifies things that can go wrong outside the normal and create contingency plans that may incur costs. That is added into your budget, so your budget can be a balanced budget. Understand fundamental accounting practices and organization-specific practices. We're not trying to make facility managers accountants. You will not become an accountant. But there are basic accounting practices that you cannot contravene. For example, how to categorize various expenses. There are account codes for categorizing various expenses. If you act ignorant on how those categorization of expenses and income and so on happens, what you are doing is making the accounting system of your organization useless. So understand how to, let's say you are doing retirement, understand how to use the templates and the proper accounting codes. If you're using SAP or any other software, know how to, place in the various categories. Learn how to do accruals. For example, there are some companies that need to do their profit and loss on a month-to-month or quarterly basis, and they need to have a recording of all committed to funds. If you've committed funds, the gardener is working for 3 months to get paid, he had not been paid, and then you don't accrue for that amount. You don't log it in as a committed amount for that period. Then you're destroying the company's accounting system. Or you have funds that you have spent and you didn't retire it on time, and you allow certain timelines to cross. Understand, and please don't be the ones looking for step out of processes frequently in your organization. In fact, it's a criminal tendency for many FMs. They understand the approval processes. They know how long it takes for turnaround time for approval. They will not be proactive, and then they'll start shouting to stampede people into jumping the gun. After all, what I'm providing is so critical, it's life sensitive, it's this and that. We can't be bureaucratic. We cannot, no. It's actually criminal tendency to try to bend the organization backwards to get things done smartly, to bypass audits, to bypass due processes because you are FM. Understand the practices. If it takes 3 days to get a certain approval and you need 2 approvals or 3 approvals, plan your activity in such a way that you can go through the entire turnaround time. If I have diesel in the tank, I need to set my reorder level to cover approval time, to cover delivery lead time. So it doesn't matter that I have 10,000 liter tank. I can order immediately, I come down to 9,000 liters because I know that it takes 9 weeks, 4 weeks for internal processes and 5 weeks for the vendor to deliver, for example. So I just got delivery. I'm down 1,000 liters and it's just 1 week into that delivery. I start the process for the next delivery. That's how FM is done. Don't wait until it is 2,000 left and then you start the process. And then when it is now 400 liters left, you start ringing bells all over the company. You're making yourself a nuisance. You may think you're making sense, but you are not. Maintain clear, well understood and documented financial handling processes. Keep accurate financial records. And this applies to organizations that are a bit more structured. You have procurement guys doing all the buying, you have finance guys paying all the money, the FM is just ordering things. And then tomorrow you now ask the FM. The FM now says, no, I don't know how much they bought it to. I don't know how much that thing costs. My friend, that is abdication of responsibilities. Or you start finding out from them the day they tell you, oh, we can't buy this, we can't pay for this. Sorry, your budget has run out in that category. And you're like, oh, how come? I didn't know my budget has run out. Who is supposed to tell you your budget has run out? The moment you have a budget, various categories are in that budget. Every time you order and they deliver to you, please get your records. Don't wait for them to keep the account for you. Keep your own financial records. And then we're trying to make business cases for certain investments. Oh, this equipment is gone so bad, we need to replace it. And management is like, it's not giving us problems. Yeah, we spend so much money, it fails 3 times a week, we spend so much money. Okay, give us the history of how much you have spent on this particular one equipment. You don't have a record of it. How can we call that professional facility management? So it's important that you have your own records. If you have budgets, monitor it yourself. Learn how to discern the managerial implications of external and internal financial statements. FMs often behave like ostriches, burying their heads in the sand. A company that is going under is being buried by the FM, and the FM is oblivious of the fact that we are going under. When they release annual reports from year to year, there are certain trends that people can read when looking at those reports. All right, I'm back. So the organization is struggling. Sales are not coming in, or costs are going up. Indebtedness is piling. Cash flow is diminished. These reports are being published from year to year. Many of us will look at it, we don't have a clue what it's even saying. In fact, at some point, you will still be putting on your boxing gloves to box the finance and the CFOs and the other decision makers about trying to make stronger cases for certain spending patterns. You know, because they don't expect you to understand the financial accounting or financial statements, they will not even bother to explain to you. They'll just go on in that merry-go-round of back and forth. No money, not approved. We have issues. Sometimes they will not even tell you. They will say we are reviewing it, and you'll just be there hitting your head against the wall. Last year, last 3 years, a trend is a pattern is coming up, and you don't take those reports and look at. I've been to an organization where I came in for a training package, you know, for the team, FM team, and just while waiting in the reception to be ushered into the training room, I've gone through certain materials, you know, corporate documents, brochures, you know, magazines they have on their table, and they have their annual reports, you know, in some of those publications. And then we get into the class and discussion starts, and I realized that my FMs have not seen those numbers. Most of the concerns and complaints they were having, were related to financial position of the organization, and we're completely oblivious of it. So please, that only puts you at the bottom of the food chain in your organization. All right, so let's look at the next concept, the principle of life cycle costing. It's about looking at everything from cradle to grave when making consideration about any kind of financing. Anytime you come around talking about let's buy this because it's cheaper than that, what cheaper? The cost of purchase, without looking into all the other costs that incidental to planning, design, construction, operation, maintenance, and disposition of that asset. We are making an ignorant proposition. Go for A instead of B. A is more cost effective based on what? Based on purchase or initial costs, or based on the entire life cycle costing? That's what we're talking about. So whenever you want to send in a proposal that compares A versus B, you can't just send in that memo. Controller A says, I will take this. B says, I will take that. I recommend Controller A. No. You may end up taking A only to meet with 10 different variations and items that makes A more expensive over time. You may end up having a lot of statutory issues, maintenance issues, a lot of human issues, inconveniences and discomforts that you cannot price or value along the way because you went for the cheap starter. Lifecycle cost also requires that if you are doing lifecycle costing for multi-year analysis, you use the time value of money. What it means is that a Naira today in your analysis is not the same as a Naira in 2023 in your analysis. So if I'm going to have an item bought at 1 million, 100,000 maintenance and energy costs every year for 10 years, I will have 1 million purchase, 100,000 for year one energy and maintenance, and then I'll use a factor, a discount factor, to arrive at 2023's 100,000, an amount I will put out today that will give me 100,000 in 2023. That should be somewhere around 90,000 or 89,000. So I have 100,000 for this year's maintenance cost because it is present. And then I have 89,000 for next year's maintenance cost, because if I put out 89,000 now, it's going to turn into 100,000 by the time I get to next year. That's time value of money. It goes into life cycle analysis. So that if I do that for option A and I do it for option B and C, the total is my absolute life cycle analysis of which is a better option to go for. And something that is buried inside that life cycle is what we call the total cost of ownership. It's often not obvious to investors and owners. Think about it. A large facility has been built, heavy investment in infrastructure, and everybody celebrates such acquisition. Not many people sit down to do the analysis, realizing that you have only just committed 10% of your total life cycle costs or on the cost of ownership at the time you are done, ready to start taking it up. Because the rest of the spending you are going to use to run that facility for the next 90, 100 years is more than 9 times what you have spent to put it up. But as at the time you put it up, that huge amount is like an iceberg. It's not visible to the eyes. Little wonder you struggle, why you struggle to make a case for spending on a new facilities maintenance. The owners are like, no, I just finished building. This thing is supposed to be perfectly working. There's no need to spend this kind of money. That's a rundown mentality because we're not ready. We didn't do a life cycle model of how we will spend A and continue to spend B, C, D, E from year to year as part of planning for that particular infrastructure. So FM's being involved in project planning and design and building operational readiness will be able to come up with data that shows how we're going to manage and maintain forever that property until disposition, by the way, because not everything lasts forever. And then tied to life cycle is this reasoning around how quickly do you make a decision regarding costs. As a development moves from planning to design to construction to operations and maintenance, it is hardening up. As it is hardening up, making changes on things that are, becoming concretized are more difficult. A change you can easily make on a design on paper at virtually no cost. I want a bigger kitchen. Still on paper, it's fine. We can just withdraw. Extra 1 hour of work, done. I want a bigger kitchen after I've painted my house. It's a different ball game altogether. the cost of making that change keeps going higher as we are advancing. So if you need to make decisions on optimization, efficiency, whatever kind of consideration, operational readiness, this is the graph you need to use to show your organization that you need to have operational readiness in place for every development, every property. Don't make the mistakes at the early stages, save all the money at the early stages, and then begin to deal with huge cost realities at later stages. The same goes for cost-saving opportunities. If I'm going to be concerned about energy consumption and the high cost of energy that the world is going to experience in the next 30 to 50 years and beyond, I need to plan now to ensure that my building fabric, the equipment I put inside my installations, inside my building, are all energy efficient. It may look stupid prescribing something like double glazed windows with inert gas filling. Some of you like, come on, that's expensive. That window will cost 3 times the cost of buying just the plain window. So you end up doing the one that's, today's money covers, and then dealing with energy for the next 100 years that can end up 10 times easily what you spent acquiring it in the first place. So use this as your go-to model for making case or business cases for early reviews, early agreement with strategy and alignment with corporate goals, so that we can get it right early enough instead of trying to fix things later. Every time you had to cut through a wall, for example, to replace a piping or to find out how something is leaking, those are things that could have been thought about, and the right type of piping with the right jointing mechanism and the right gauges and pressure ratings would have been decided upon during design and construction, not after everywhere has been tiled. You come into the house and be like, well, I don't like the pressure of this shower. I need to increase the pressure of the shower. And then they put in another pump to increase the pressure of the shower. And they have leaks everywhere. And what just happened? We use piping and joints for a lower pressure because we didn't expect that you will want to use high pressure showers, right? Now we'll face that repercussion. We have to start cutting everywhere to fix things. So right now you can fix that before you even dig ground, before you even get to that point where you have to deal with that kind of change. All right. Another consideration for FMs when it comes to finances is, must you always buy? Have you asked yourself that question? Must you always buy? What do you really need? What do you really need? Some of us feel that we need a table, a generator, a transformer, a water pump. We don't need any of those. People who want to sell those are happy to sell. But what we actually need are the utility that comes from them. If what we need is the utility, for example, I need a comfortable environment for my organization staff to, carry out their task. Because that's what I want, that's what I really need, I ask myself, what are the options for providing a conducive environment for them to work? I can buy land and build a house and furnish it. I can rent and furnish it. I can rent already furnished. I can go for pay-as-you-go spaces every day, 5,000. See how the options opens up. then each one will not be analyzed separately. What's the implication on tax for each one? What's the implication on cash position of the organization for each one? What's the implication of my decision, what I call my opportunity costs of one decision as it affects the other alternatives? You probably have been pushing for a brand new generator all along. The price went from 4 million, now it's 7 million, and you are shouting, "Ha! I said it, we should have bought it when it was 4 million. You see how stupid it is for us not to have bought it then. You are still talking about generator. You still haven't brought your mind back to, what do I really want? Is it generator or I want power? And what are the options for power? I can buy the gen, do the analysis. I can lease a gen, do the analysis. I can buy power from someone else who has a gen, even if he has to bring the gen to my site and meter me when I'm using power. I don't have maintenance, I don't have any issues. It's possible. The options are all there. But FMs block their minds and keep hitting on management. We need release, we must acquire new projects. If your organization has a lot of money, you know there's cash flow, you know the money is there, and you know that the money is not even yielding any reasonable interest from the bank, then the organization should be investing the money. It's a good thing. Let's buy our own, let's build our house, let's invest in this and invest in that. Fantastic. But if the organization is looking for money, borrowing money to get by on a day-to-day basis, why should I be the one that want them to go and borrow to come and pay a generator manufacturer when someone else can power me for today, and I get the power to produce for today, and I get the revenue of today, and I pay him for the power I use for today? I know the FM will be like, if we just, I will be spending 800,000 a month. In just 10 months now, we have spent 8 million. Can you imagine? Instead of just buying our own for 7 million that we can use for 4 years, in just 10 months, we spend 8 million. It's foolish. By the time you are saying that, you think you are making sense. I hear it all the time. Statements that are not backed by proper analysis, not backed by, alignment to corporate objectives or standards or corporate requirements. You need to do the numbers. If your organization has 7 million today to spend on that generator and did not spend the 7 million, but paid 800,000 to lease another person's generator so that you can have the full utility of your own power, how much was reserved? 6.2 million. Between the months that we spent 800 and the next month where we will spend another 800, how much more can we make with our 6.2 million in case, just because we didn't spend it? Simple, internal rate of returns. If you as the FM can open your mind to understand the kind of numbers your organization has to deal with, you will no longer be the one recommending buy generator. You'll be the one saying, you know what, let's lease for 800,000 a month. Because that gives us a low cost entry, a cash flow positive decision that gives us return. Because at the end of that month, we would have been productive, we would have made something, and we can pay the 800 and make money back. In fact, from month to month, we may be able to use what we did not. All right, welcome back, everybody.
Welcome back, sir.
Thank you.
Welcome.
Thank you. So FMs, we spend money and we have to, allocate costs for different things. In many instances, we have to spread this cost out to those who are the cost bearers, the customers. We call this service charge, you know, all kinds of you know, charges for what we spend. We want to share it out, right? Sometimes we're trying to justify profitability, and so we want to, you know, work out what our gross margin is, what our net profit is from various FM activities or transactions. So you need to know some basic cost concepts. So we start with direct and indirect costs. Direct costs can be specifically traced to an item or activity. They can be easily and accurately traced to a cost object. A cost object is more like a cost driver. If I produce 10 items and I spend 10,000, 1,000 per item, those are the costs I spend directly on each of those items, right? So that's why it's called direct cost, like direct labor, direct materials used, and so on and so forth. Direct costs are easy to track. In project management, we call this hard costs. Hard costs because they can easily be estimated, they can easily be tracked, you know, they can easily be monitored, you know, clearly, because for every increase in output, there is an increase, directly proportional increase in direct costs. Indirect costs spread over a period of time, regardless of specific activities. They are costs related to a cost object, but not directly and solely associated with that item or activity. So if a technician, for example, does a certain job type, maybe electrical technician, he works for 20 different home owners. For one, he fixed just a bulb. For the next one, he did a rewiring of their DB that took fire. For the next one, he did installation of new sockets, and then he wired an entire apartment for the next one, and so on and so forth in a particular month. All the direct labor, you know, for example, the laborers brought in for that job, the electrician's job, and so on and so forth will be easily calculated. So let's assume you even have multiple electricians doing all of this work in your project, but you have this supervisor or this electrical foreman who is in charge of all of this, and you want to estimate what his own costs on a particular client's job is. That will become more difficult, because how do you divide salary into 20 different customers' jobs when each of the customers' jobs are different weights and different volume of work? So that's why indirect costs are often taken as overhead costs. They're just taken as overhead costs, and they can be arbitrarily applied through what we call cost allocation or cost assignments, like you do in service charge accounting. All right, so insurance premiums, maintenance costs, utility costs for common areas, for example, salaries of, you know, service teams and maintenance teams can all come in there as indirect costs. You may want to do a little bit more research on cost management structures, how to attribute cost, how to allocate costs, and if you have specific questions, you can put them in the chat. I would like to respond to them, because cost on its own is a huge area that it's a very vast area. For most of you who are managing estates, for example, you have customers complaining about equitable distribution of costs. You have cost recovery challenges. For equitable distribution, you're probably using the wrong measure or driver to distribute. For example, somebody who's using square meters or number of bedrooms in an apartment to split up common area electricity cost, for example, might not be equitable, right? And then cost recovery, you put in a massive generator because you think everybody will need power from you, and then in summertime, half of them are on vacation abroad and they're not buying any power, but you have to run the entire equipment, and you don't know how to recover the cost. Those are things that needs to be thoroughly looked at. We do a lot of activities in this area where we look at your real costs and the users of the cost, how to apply it. So you can now use factors like a fixed cost for equipment acquired, shared across every user or tenant, whether they are there or not, as their cost of the equipment. And then we have service charge distributed in such a way that there are two sides to it. There is the fixed service charge for just being there, more like a holding charge. And then there's a consumption charge in the service charge, so that if you are occupying your space, you have a lesser amount to pay, not zero. And if you are more, rather, you have a higher amount to pay. If you are not occupying your space, you have a lesser amount, not zero. So that way you can factor in some of these considerations in recovering your, because those are the main issues that you have as an FM: recovering your costs, justifying your costs, and distributing it equitably are the two main concerns that FMs have. That you need to understand the cost concept, to be able to break down costs in such a way that you can get a full understanding. I've seen FMs trying to, manage power costs, and they will just put in diesel costs, and then they will put in utility bills as the two costs they are going to distribute. By the time they do maintenance, by the time they do all the other things that go with owning that equipment, repairs, overhauling, and the rest, you find out that much of your cost cannot be recovered. And so the tariff you have chosen or picked on is often too frozen, too rigid. Oh, we've agreed that we're going to pay 100 naira per kilowatt hour, right? Now, 100 naira per kilowatt hour, what kind of margin does it give you when you work out your cost? If you just do your strict costs and you divide it out by what you anticipate is going to be consumed by everybody, and you get 100 naira per kilowatt hours, what happens to when people don't take? What happens to when people don't pay even after taking? How will you recover your costs? Those kind of margins are things that you need to also consider. But first, understand your costs and know how to mark them up to cover for those concerns. And then the concept of financial best value. It extends the conventional wisdom pairing value and money, and instead implies a need to continually strive for something superior at the lowest practicable cost. Value is about the relationship of cost of price and quality of performance. Ideally, cost and quality should both be considerations in the FM decision. Cost should take sole priority only when financial constraints are severe and they take so. What is this? Think about value, not just the cost. Best value is pairing the two. But how do you determine best value? Best value is determined when you carefully outline, define, using metrics, specifications of what utility you want. And then going for the cheapest, lowest practicable cost to achieve exactly what you want. If you describe, using some of the lessons you learned from the quality management class, how to specify and define service levels and scope correctly. Once you can get that right, nothing beyond or above the cheapest price is best value. So let me give you a simple example, an illustration I commonly use. You want to get a device for your technicians to work. You want them to be able to scan QR codes of assets, report data on from the meters, for example, on usage, updates, maintenance records, and report parts changes and so on and so forth right in there, so that there will be no paperwork in your operations and maintenance. Super. We need to get them handhelds. The handhelds could be phones, could be tablets, right? We decide that it should have a minimum screen size of 7 inches. Okay, noted, 7 inches. We decide that it should have color screen so that it can, see clearly. Oh, well, noted. We decide that it should be able to use 4G networks. Okay, noted. And we went on and on. As soon as we were done with those specifications, we go seeking for bids. We go searching them, scanning the market for options. And we came about 2 options. All conditions met. One is 100,000 per unit. The other is 101,000 per unit. It makes common sense to just pay 100,000 and forget about the 101,000. But then there's a twist. The 101,000 has a very big battery that can last 1 week. So a technician does not even need to remember to charge his battery for that device. But the 100,000 one, he has to charge twice during the day of operation. If I were to take a poll in this class right now and ask, which one will you go for? The 100,000 or the 101,000? Majority of you will say, I will go for the 101,000. Why? In your thinking, there's this extra value of this battery that, for just extra 1,000, they can even run for a whole week without charging. Fantastic. I must go for 101,000. It will be stupid of you, very foolish, lacking analysis, to come to management and say, I spent 101,000 when there was an option for 100,000. Why would it be foolish or stupid? Because that extra perceived value that you thought 1,000 naira should have gotten for you was not listed in your original specification. In fact, if it becomes so critical that you go for that one, what you should do is you come back and rewrite your specification and indicate that the battery life must be XYZ. In this new specification, automatically option A that was 100,000 before drops off consideration. It's no longer being considered because it failed the requirements of that specification line item of battery. So you now have only option B. But of course, you cannot just have one option. You have to have 2 or 3 options, right? So you scan the market deeper and further, and you find a few more options. Luckily for you, you might end up with the 101,000 as the cheapest of all the options that meet all the requirements. You might be lucky enough to find another one that is 100,000 and 900 naira. Even if it is 1 naira difference, the cheapest that meets your requirement is your best value. Now to this concept of deferred maintenance. Deferred maintenance is the difference between how your facility looks and how effective you have been in managing. If your facility looks run down, you have fully, in clear details, captured all the defects that helps to account for the rundown feel, appearance, functionality of your facility, you are an effective facility manager. Because you can show that all the defects are well understood properly scoped, priced, and there is a reason why each one has not been done. But if you don't have this accounting in place and your facility is looking run down, you are a crappy facility manager. That is the truth about deferred maintenance. We use it to show who is on top of his game or who is not. What do you have in a deferred maintenance log? The location, the system or equipment, the defect observed, the scope of work to fix it, the cost to fix it, the priority of that particular defect or that asset, and then the reason why it's not been done. And then you can now continue with more columns where you have status assets perpetually, so that if an item gets fixed, you have an updated status corrected. If it is not fixed because there's no budget, the status assets this weekend is budget not available or funding not approved, and so on and so forth. The second reason why we study and put in place deferred maintenance is what we call the facility condition index. The facility condition index is a technical term for accounting for the condition of your facility and comparing facility A versus facility B. If there are two facilities, there may be different types of facilities. A hospital versus an airport, which one is in a better condition? A school versus a road, which one is in a better condition? You use the FCI. The FCI is calculated using deferred maintenance plus capital renewal divided by current replacement value. It comes out in a ratio or percentage. 0.05 and below, or 5% and under, is a facility in good condition. The FCI is very low, the condition is very high. 5 to 10%, 10% to 30% gives you different judgment as to the condition of the facility. So if you have a 60% or 50% FCI, it tells you that the facility is really, really run down. The implication of this formula really is, what is the cost of repair compared to the cost of replace? I want to get a fully functional utility or asset. Should I get a new one or should I fix what I have? It is FCI that gives that indication. If the FCI is low, fix, maintain. If the FCI is high, it means that the ratio of repair versus replace is so high that it's better you replace. The next financial concept I'm going to talk about is the 70-30 principle. Be proactive instead of reactive. If you have a higher ratio of what you do as proactive, pre-planned, pre-scheduled activities, your cost will go down. Emergencies, sudden repairs, sudden failures, certain reactive actions, they tend to cost more because we are acting on the spur of the moment. If I stock light bulbs, for example, I'm being proactive. I can negotiate better. I can get a good value, good discount. But if I have to go and get one bulb at a time, I will not only pay retail price, I might also pay hostage price. When I have only one option and I have to fix it now, someone can hike up the price and I will not see any reason not to, because I have no other option. All right, so let's get into budgets. Many of us would think of budgets as the money we will spend. Your budget is not just the money you will spend. Your budget is the entire plan of what you will do. A formal numerical expression of how an organization expects to operate for a defined period of time. What this means basically is, for me to say I have a budget, I have figured out everything that needs to be done. First, I know what I must achieve, and then I know what I must do to achieve what I must achieve. Then I lay all that out, showing the periods for various activities and the cost for every activity in every period. It's both income and expenditure, and it goes in the form of a cash flow projection. What it does is it forces us to think ahead. It helps us to communicate better, because as soon as the budget is in place, we tend to appreciate, because we now understand what we are required to do. Cost control, yes, we use our budgets to control costs, because we are looking for options and alternative ways of getting things done while doing the budget. Don't go ahead and pack a budget up only to start doing implementation, start saving costs and celebrating it. No, saving costs happens in budgeting. Because if you did not save costs while you are budgeting, and then you save costs after budgeting, you have done something that is very criminal. You have tied down funds that the organization could have used for something else, and you end up not spending it. That is why budget overspending and budget underspending is the same level of offense. So if you want to save costs, save it while analyzing and planning your budget, not after. Because all the money you save while doing your budgets should have been applied to other areas of the organization. So it's not tied up in the budget and eventually saved and celebrated. No, that's terrible. And while you are doing budgets, you see that first concept we introduced, that alignment with the organization's mission. It is in a budget you actually put out line item by line item, how they align to the organization's core business and core strategies. So every time you have budgets and they're not being approved, they are being trashed, they are being argued, your defense is becoming more difficult. There are just two things. One, it's not properly aligned. You've not shown the value of every line item to corporate strategy and corporate objectives and the mission of the organization. And two, your assumptions, you are leaving them in your head, and people that are looking at your budget are having a lot of questions to ask. So instead of that, whatever you were going to prepare to use to come and defend your budget, put it inside your budget on line item basis. So that when I see your budget, I see your assumptions, your defense, your justification, the rates you deployed, for example, minimum wage, for example, cost per hour of ABC, cost for materials, forex, considerations for things that are going to be imported and so on and so forth. You put all of them in the assumptions to make it clear. Your budget as an organization could be authoritative, which means senior management basically much decides everything. They give you the goals to achieve and the amount to spend. You, as an FM, needs to creatively put together your budgets on how to spend that amount to achieve what needs to be achieved. The participative budget involves, virtually everybody in the organization. It's called the bottom up, not the top down that is authoritative, because people build the budgets from the bottom. What they'll do is build an aggregated up, even though management will still take a decision on what the ceiling of spending should be and the final approval. A combined budget combines both of them. It's called a participative budget, iterative budget, two-way communication. Management gives us the objectives, we build our cost from the bottom, management comes back with the final approval and say, yes, I think you're in alignment with what our goals are. Those are budget approaches. Now we come to budget methods. Budget methods could be incremental, which we also call the historical budget. This is a budget that is built on the base of previous budgets. The line items of previous budgets and costs and expenses are there, and then you put the next one on it and say, what changes should we make on each of these line items? You're changing costs, elements, but the line items are there. The zero-based budget does not have any reference to previous costs, but it refers to previous line items and tries to give consideration for every line item, whether to retain them or to jettison them in the current budget plan. So you're thinking more critically about budget line items. But when you are done with budget line items in the zero-based budgeting, you put in costs for each line item. The cost will be completely independent of historical costs. You are looking at what activities you want to achieve, what results you want to have, and how each line item will contribute, and what costs you're going to spend per line item. That's zero-based. It is similar to incremental in the sense that you are still working based on something historical, but that historical item is just budget line items, not budget costs, which is zeroed out. In the activity-based budget, you are focusing on activities. You are not looking at anything historical. In fact, you are starting on a clean slate. Every time you didn't have a budget before and you had to start creating a budget, you typically will start with activity-based. You look at what you want to achieve and the activities you need to perform or carry out to achieve what you want to achieve, and you build your budget from scratch. It helps you to focus on value-added activities. It helps you to weed out irrelevant things that will not add value to what you're trying to achieve. And then we have the budget types. The operating budget, 1 year budget for routine activities, all the activities that you're performing for a particular year, acquisition of materials, consumables, assets that are going to be in use for 1 year period are all under operating budget, including salaries, insurance, and the rest. And then you have the capital budget that is for long-term spending. Your master plan, your strategic facility plan will throw up certain projects that once implemented will give you more than 1 year of utility. We have value running multiple years that will be more structural and more high level. Those are the ones we call capital renewal budgets. So replacement of interlocking tiles, a generator, refurbishing or overhauling anything, replacement of certain components, and so on and so forth, will typically fall under the CapEx budget. So that's our lesson in a nutshell. We've looked at life cycle, TCO, cost of ownership. We look at cost concepts and budgets. Now you can ask your question as I turn over the time to you. Please don't forget there's an assessment with this with this class that you need to do today. I noticed that some of us have been having some challenges with submitting assignment and assessment in the portal. I believe that was resolved as at Wednesday. If you're still having an issue with submitting on the portal, please, let us know specifically what challenge you are having in a direct message to Barakat to take a look at. I see a couple of you, but please, if you have submitted assessments and you're not sure the assessments have been recorded, kindly request for, send an email to training so that your assessments on that has been captured will be confirmed. You just send an email to say, I've submitted this course, that course, that course, that course, please confirm. Then a response will be given to you if it is. If it is not, you'll be asked to reload them into the portal, okay? All right, so let's hear your questions. Kiki, go ahead. You can unmute.
Thank you, sir. My question is on budgeting.
Yep.
So I remember you mentioned that both overspending and underspending is
Equally
wrong.
criminal. Yeah.
So in a situation whereby, let's is this scenario, maybe 2021, the running hour of generator was on high side.
Mm-hmm.
So we don't have much of a PACN power supply.
Mm-hmm.
Then based on that 2021 budget, so we now forecast that, okay, peradventure the same thing will happen in 2022.
Mm-hmm.
But fortunately for us, there is improvement in power supply.
Mm-hmm.
Now, the running hour of generator reduces, that will affect the
Cost on diesel.
The cost on both diesel, both maintenance.
Yeah, yeah.
So in such a situation, is it criminal or it is acceptable, sir?
It's not. It is an external factor. Your assumption clearly stated that in 2020 we had generator use for 10 hours every day, right? And we're estimating that we're going to use 10 hours every day in 2021. But in 2021, we use only 2 hours, sometimes 0, right? So because I stated that assumption in that budget line item, I'm okay. It's an external factor that I couldn't control beyond that assumption. That's fine. Right?
Sir.
What it's criminal is coming back to renegotiate things, find better options to get it done cheaper. That's what is bad. Okay, you have to make sure that you already have considered all of those during the budgeting cycle. Okay.
Okay.
Thank you. Actor Shogo, go ahead.
Okay, good day, sir.
Yeah.
Yeah, so sorry, kindly pardon me, I won't be able to on my video. So
Okay.
quick one, on that life cycle costing, you talked about using time value of money, and there was a place trying to do an example of when you're trying to do budgeting and you're like making provision for the cost of diesel this year and then next year. So I didn't quite get that that area of time value of money, for this time and. Yeah.
Okay. A naira today is not the same value as a naira next year. It's not the same value as a naira in 2025. Okay. Now, how do I know the naira, the naira, what the value of the naira of 2025 is today? I ask myself how much I need to put in a bank, in a fixed deposit account between this year and 2025 to get the amount I need in 2025. That's the amount I used to do my comparison now. So if I put out 80,000 now, will I get 100,000 in 2025? Right? Because I want to spend 100,000 in 2025. In my analysis, in my life cycle analysis, I cannot use money without considering their time value. So I will use an interest rate that will give me the amount I need then to apply to an amount today that I'll use for my analysis. So I can say 100,000 for year 1, 90,000 for year 2, 80,000 for year 3. I'll arrive at 270,000 for 3 years diesel cost that is equivalent to 100,000 every year, or maintenance cost that's 100,000 every year. Okay, now why do we do this? Some assets may have low front-end investments and high back-end costs, right? The effects of not spending heavily at the beginning should show in your analysis if you use time value of money. If I ask you in a similar sense, a question like, I want to deliver a service to you. Let's say I want to clean your property. Every year, you are supposed to pay me 100,000 every year. And I want to sign a contract of 25 years with you. If I tell you to choose between giving me 100,000 every year for 25 years or giving me 1 million now, and I will work for 25 years, you won't pay again, which one will you take? Many of us will choose A or B without doing calculations. Both will be wrong. You have to calculate first. 100,000 this year plus 92,000 next year plus, if I'm using 8% discount rate, plus 89,000 naira the next year plus, that's how I'm going to add up to 25 years and compare that to 1 million now. So if it is 1.1 million for 25 years at time value of money of every year that I added up, and you're asking me to choose between paying 100,000 now and paying 1 million now, and I realize that if I pay 100,000 every year to be 1.1 million, I can pay you 1 million now and not pay again for 25 years. But if I do my calculation and I arrive at less than 1 million over that 25 years, because every year 100,000 is shorter and shorter. In fact, by the time I get to 20 years, I'll be using 15,000 of today's money to pay that 100,000 then, right? That's exactly what I will add up. It might end up being less than 1 million. So paying you 1 million, that may be stupid. That is time value of money. I could also use my internal rate of returns to say 100,000 out of my 1 million, I still have 900,000. Can I make more than 100,000 by even 1 naira between now and next year? If I can make more than 100,000 on my 900,000 left, I won't give you the 1 million now. I'll keep paying you 100,000 every year and end up 25 years of fulfilling my obligation and still having my 900,000 with me, or even more, right? So these are mathematical analysis that we need to start coming to terms with as facility managers.
All right. Thank you.
I'm sure many of us remember 4-figure tables those days in school. You don't know what they are using it for. We just keep looking up and looking the row, looking the column. And this is what it is used for. Looking for compound interest and looking for time value analysis for future monies and so on. Yes, Chuchu, go ahead.
Good evening, sir. Thank you for the presentation. Sir, please, I would just like you to talk a bit about slide 13, where you talked about lease, or I didn't hear anything while you were speaking on that slide.
Whether to acquire an asset or to lease it, to rent it, or just to get utility, right?
Yes, maybe just summarize, because I didn't hear anything.
Okay, I see. The summary really is, don't always think in terms of commodity. You don't need commodity. You don't need any equipment. You don't need a building. You don't need a generator. You don't need a ceiling fan. You don't need a borehole. What you need is what those things give. And your analysis should start from your utility request or requirements. I need water to drink. What are the ways to get water? Drill a borehole, truck it in with a tanker, buy bottled water, buy in dispensers, pipe it in from a neighbor. There are so many options, right? But because I started with it is water I need, and I want the cheapest source of water to meet my need. Drilling a borehole might become an overkill. Spend 5 million, drill a borehole, only to take out one tank pumping or one tank a week, for example. In a year, I may end up with 5 million spent originally, maybe another 200, 300,000 on maintenance costs. By the time I do my cost per liter, by the time I do my cost per liter, I might end up with a liter at 4,200 naira because I drilled my borehole.
So basically, we must do a cost-benefit analysis for.
Exactly, with all the options before you go for what is best. That's best value. If I need electricity, I can get it from solar. I can depend on the grid using inverter to back up. I can get generators, diesel or gas. I can decide not to get any of those and get somebody who sells power to bring his generator and give me power. Because I think way back and start my analysis from exactly what I want, I will get the cheapest solution to what I want. Many of us are buying generators and operating a very, very wasteful operations, spending heavily on maintenance with oversized generators because we're not even, calculating how much a kilowatt hour costs us and how many kilowatt hour per person and how much it costs us to house one person. When there was COVID, it is only the FMs who have learned what we are teaching now that we're able to justify the pressure that management brought. Nobody came to the office, and then your total facility cost only reduced by 0.05%. How? How will you explain that you used to spend 10 million, now you spend 9.8 million when nobody came to the office? All along, you've not been doing these metrics to show exactly what the cost of facilities is to the organization. Now you are not in a quagmire. How do I explain that costs are not going down with nobody coming to the office? If I was tracking my metrics before, I know my liters of water, and I'm tracking it according to how many people come to the office. If people don't come to the office and water use still is high, maybe 10 people come to do inspection and 20 security men came to, and then water is 4,000 liters for that day. I won't wait for management to ask me why am I not bringing down my cost? Immediately I would tell the guys there, you know what? Pump only once a week. I don't want to use energy to pump water that you are wasting, because the rate of water use that's what it means. If you are just 500 man hours compared to 5 million man hours before, I must have that kind of thinking. Otherwise, I can't justify what I'm doing. I can't show the value. If management is trying to say, let's move everybody from coming to the office to working from home, can I drop a number on the table and say, if we have 100 people working from home, we'll save 200 million? Can I do that? I don't even know what it costs each person. It costs me to manage each person in the office. Okay? Ndika.
Okay, good evening, sir, and thank you very much for the lecture, because at least I've been able to discover the fact that we can't just keep our options as simple as we should, because we should even spread further to find out more and make research on how better we can make our best options. But I want to ask, maybe after you've arrived at your figure and you've passed out your budget and it has been approved and all that, and is it criminal in any way when at the end of the year or the budgeting year you want to you're supposed, because knowing that your organization, when you do not spend everything that's given to you, if you do not spend everything and they know that you have leftover cash, that they will reduce the value for next year.
Yeah.
So now people start, is it criminal to start screwing for projects that you want to do so that you can end up spending your money?
Yes, it's actually corrupt to do that. But if you have a deferred maintenance log with prioritized deferred activities, that means you have before you things that are not perfect in your facility, so you can spend that money in doing it. It's fine.
Okay.
You upgrade your facilities to standard. But when you now start dumping it on cosmetic things that are not prioritized, like painting the whole place or redoing a car park just to spend 500 million as quickly as possible, then there's a lot of corruption that goes in there. And the whole idea of trying to justify a budget to be big enough for next year is actually corrupt. I can spend very little because that's what I need to spend. And if the next year I need to spend a lot, justify it, and I'll get a lot.
Okay.
Let's hear
sir.
from our training manager. Barakat, you want to say something? Barakat, your hand is up.
Oh, no, sir. That was a mistake.
Okay. Austin, go ahead.
Thank you for the class. I want to ask, concerning the justification of the budget now. So, in a situation where you have budget submitted, and in the fiscal year of that budget still running, you have done all options for a project, but in that fiscal year, you decide another vendor just pop up and gave you a lower and, of course, quality job as just opposing what you have budgeted for before. It's criminal to actually use that new vendor.
It is not, but you must make an objective record of this your sudden find.
Okay.
You must write a justification that you are taking advantage of a sudden find. With all your research and due diligence earlier on, you did not know that this new thing can be possible. For example, it could be a new technology that this vendor just happens to be the OEM for, and it will solve your problem better and cheaper, right? You take it, but you must record it, because at the end of the year, when you are doing your budget reports, the way you justify any overspent line item, that's how you justify any underspent line item. That's the whole idea. It doesn't mean that it will not happen, because of course we keep saying there should be no variation, but there's always going to be variation. But be able to have objective records of why those variations exist, okay? All right, thanks everybody. I think it's been a very fantastic class. I hope you've taken notes. And please don't come to class on Monday and not have questions or takeaways. So please, I hope you'll be taking notes. You must have takeaways from each class, and you must have questions and things you're trying to apply this training for, that you need support and resolutions for. Okay. Thank you. Bye. Have a nice weekend.
Nice weekend.
Thank you.